Welcome back to the deep dive. We're here to give you that shortcut, cutting through all the noise to help you really understand what's moving the economy and the markets.
That's right.
This deep dive is really designed to help you, our curious listener, get a quick handle on the key trends from last week. That's June 30th through July 7th, 2025. And importantly, what to keep an eye on going forward.
So our goal isn't just throwing headlines at you, it's digging into the why.
Yeah.
Why these numbers matter for the bigger picture you're building.
Okay, let's jump right in then. The economic headlines from last week. Because we did get some surprising news on the U.S. economy. Starting with the ISM manufacturing report, It came in at 49.0, so a little better than expected, up from the month before. Now, okay, it's still under 50, which, technically means contraction.
Right, still contraction.
But it was the first increase we've seen after 4 straight months of declines. So is this little bump, is it really something to be optimistic about? Or just noise?
Well, it's potentially significant. Even a small increase like that matters because it's a forward-looking indicator.
Okay.
Markets look at things like the ISM for signs of a shift. So seeing it tick up, even slightly, after falling for months, it suggests maybe, just maybe, the manufacturing sector is finding a bottom, or at least the decline is slowing.
Okay, then Thursday, we got the big one, the jobs report.
Yes, the jobs report.
And the headlines, well, they looked pretty good, right? Non-farm payrolls up 147,000, which beat the forecast. And the unemployment rate actually fell, surprisingly, to 4.1%, lower than expected, too. So on the surface, that seems, pretty strong.
It seems strong, but you really have to unpack this one.
Okay, so what's underneath?
Well, the headline number, the 147K, it masks something important. Private payrolls. So jobs excluding government to CABUS, they actually missed expectations pretty significantly.
Oh, okay.
They came in at just 74,000. The expectation was for 100,000.
Right, that's a big miss.
It is. So that makes the overall report actually weaker than that headline number suggests. It kind of reframes the whole picture. And then there's the participation rate. It fell again. And, it's still consistently below where it was before COVID. We're averaging around 62% since April 2020 versus like 63% the decade before that.
So fewer people are even looking for work.
Exactly. Which means that 4.1% unemployment rate, while it looks good on paper, it's arguably weaker than it appears because it's based on a smaller pool of workers.
Got it. That really does put a different spin on it.
Yeah.
Okay, and then switching gears a bit, there was legislative news too. President Trump has been pushing the One Big Beautiful Bill Act.
Right, the tax and spending bill. Passed along party lines, mostly.
Yeah, and already there's a lot of debate about what it's actually going to do, for growth, for deficits.
Absolutely. And that debate is pretty central right now. You've got one side arguing, look, this could boost growth, through tax cuts, maybe some spending initiatives.
Stimulus effect.
Right. But then the other side is raising concerns about, the national debt. Could this significantly increase the deficit? What are the long-term economic consequences?
So uncertainty there, too.
Definitely.
Okay, so that was last week. Let's look ahead now, because you mentioned there aren't really any major economic reports scheduled for this week.
No, it's a quieter week on the data front.
But markets are still really focused on 2 specific things happening.
That's right. 2 significant events this week. The first one is on Wednesday, July 9th.
Okay, what's happening Wednesday?
That's the deadline for the extension President Trump put on those tariffs. Remember, he delayed them.
Right, the tariff deadline.
Yeah. Now, we know about some adjustments for Vietnam, South Korea, Japan, but for pretty much every other country, there's still a lot of uncertainty. It's created this kind of anxious waiting game for a lot of U.S. trading partners.
And we even heard Treasury Secretary Bessent talking about this on Sunday. He had a pretty direct quote.
What did he say?
He said, President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2 tariff level. And then he added, I think we're going to see a lot of deals very quickly.
Wow. Okay. That's pretty direct language.
Yeah. What does that signal to you for the markets?
Well, it ramps up the pressure significantly, doesn't it? It tells those countries, basically, the clock is ticking very loudly. Negotiate now or face those higher tariffs again on August 1st.
So potential for rapid developments.
Exactly. You could see a flurry of last-minute agreements, or, if deals don't happen, a pretty sharp increase in trade friction very soon. It keeps trade tensions front and center for investors.
Okay, so tariffs on Wednesday is number one. What's the second key event?
Also on Wednesday, we get the minutes from the last Fed meeting.
Ah, the Fed minutes. Always important.
Always worth reading closely. This will give us some insight into their thinking when they decided to hold interest rates steady last month.
Right, and speaking of the Fed, market expectations for rate cuts have shifted dramatically, haven't they?
Oh, massively. It's quite striking. Just look at the odds for a rate cut in July. Last week, the market was pricing in about a 21% chance.
Okay.
Today, it's under 5%.
Wow, that's a huge drop.
It is. And looking out for the rest of 2025, the probability of seeing more than 50 basis points, so more than 2 quarter-point cuts that dropped from 62% last week down to only 29% today.
So the market's really dialing back expectations for Fed help. Why the big change in thinking?
Well, it seems to be those two things we just discussed. First, that jobs report, even with all the nuances we talked about.
The headline was still strong.
The headline was strong enough, yeah. And second, the passage of that tax and spending bill, the One Big Beautiful Bill Act.
Okay.
Taken together, those two things seem to have boosted expectations for economic growth. So the market is basically saying, maybe the economy is doing a bit better. Maybe it doesn't need as much support from the Fed through rate cuts.
Less need for cuts if growth is looking stronger. Makes sense.
Precisely.
Okay, so with all that swirling around the jobs data, the bill, shifting Fed expectations, how did this actually play out in the markets last week? Let's start with U.S. stocks. We saw large cap stocks, growth stocks, the NASDAQ. They all hit record highs last Thursday after that jobs report came out.
They did react positively initially, yeah.
Though they did give some of that back on Monday. But were other parts of the market telling maybe a different story or a more nuanced one?
Yeah, it's interesting. While the big tech and growth names grabbed headlines hitting records, if you look a little deeper, small cap stocks actually had a stronger week overall. They were up 1.8%.
Okay.
And value stocks also did better, up 0.9% for the week.
And why is that significant? Small caps and value?
Well, those segments tend to be more sensitive to the overall economy. So seeing them outperform suggests that maybe investors are buying into that stronger economic growth narrative, at least to some extent.
Gotcha. More cyclical exposure there.
Exactly. But, and this is a really important but.
Uh-oh.
Well, it's just that the market right now seems to be pricing in, essentially, no major negative surprises. Everything going smoothly.
Optimism baked in.
A lot of optimism, yeah. Which means if we do get some major negative news, whether it's macro news or geopolitical or maybe something with those tariffs, the market could be quite vulnerable. It could swoon, as they say.
Good point. So fragile optimism, maybe? What were the final numbers for the main indexes then?
For the week, large cap stocks overall finished up 0.4%. Growth stocks were up 0.2%, and the NASDAQ also up 0.2%. So positive, but off those Thursday highs.
Okay. What about outside the U.S. world stock markets? Did they follow the U.S. lead? Developed markets were down 0.9%, emerging markets down 0.4%. So they underperformed.
They did underperform U.S. stocks, yeah. And a big reason for that actually was the U.S. dollar.
Ah, the dollar effect.
Yep, the dollar strengthened recently. And for a U.S. investor, when the dollar gets stronger, it eats into the returns you get from your international stocks when you convert those foreign currency gains back into dollars.
Right, currency translation headwind.
Exactly. So while those markets had their own things going on, the stronger dollar was a significant factor dragging down the returns for U.S.-based investors last week.
Okay, makes sense. Lastly, let's touch on bonds and interest rates. You'd expect bonds to sell off with a strong jobs report?
And they did.
Because stronger growth usually means higher rates. Bonds sold off significantly last week. Was it just the jobs report driving that?
It was definitely a factor, but maybe not the only one. It's interesting because rates actually rose every single day of the past 4 trading days.
Oh, okay. So it wasn't just a Thursday reaction.
No, it seems like a broader trend was building through the week. And connecting back to our earlier point, that tax and spending bill, the One Big Beautiful Bill Act, that seems to be playing a role too.
How so?
Well, bond investors are looking at that bill and focusing more and more on the growing U.S. deficit, the prospect of more government borrowing to fund tax cuts or spending. That can also push interest rates higher.
Right. More supply of bonds, potentially higher yields needed to attract buyers.
Exactly. So it's likely a combination.
Yeah.
Stronger growth expectations from the jobs report, plus increasing concerns about the deficit picture fueled by the new legislation, both pushing rates up.
So putting it all together for you, our listener, it was really a week where, those positive U.S. headlines, like the jobs number, they didn't quite tell the whole story once you dug in.
hidden weaknesses.
Yeah, with private payrolls and the participation rate. And meanwhile, actions in Washington, like that big tax and spending bill, are clearly rippling through markets, affecting everything from rate cut expectations to worries about the national debt. It's definitely not a simple picture.
No, it's complex. And maybe the thought to leave you with is this. Considering that market sentiment we talked about, the fact that it seems to be pricing in, no major negative surprises.
Right, the optimistic view.
Yeah. What could the impact be? What are the implications if these ongoing debates about the new bill or the uncertainty around that tariff deadline?
Yeah.
What if they don't resolve smoothly in the coming weeks? How stable is the market if that optimism gets challenged?
That is a great question to think about. A potential mismatch between market pricing and underlying risks.
Potentially. Something to keep watching.
Absolutely. Thanks for joining us for this deep dive.
We'll see you next time.